The election here in the U.S. was, I think, the number one factor for the quarter. Markets behaved as they normally behave. The uncertainty is over, and there's a force to be reckoned with, and that force was higher in the stock markets globally. We also saw weakness in the bond markets, and that's having an effect on steepening the yield curve at this point, and that's benefiting many of the stocks that are quote-unquote value stocks in the market. So financial services companies, commodity and industrial companies that are more granular into the core economies. The other factor that occurred this quarter was a coming together of OPEC with the non-OPEC nations and deciding to cut production. Now, we'll have to see longer term how this affects commodity prices, specifically in energy, but we're optimistic in the short term that this should help underpin some of the emerging market economies that are dependent upon commodities for economic growth. Financial stocks have done fairly well on the back of the rise in interest rates, so an indication that the markets are anticipating an increase in net interest margins for these businesses, where there really hasn't been much of that for these businesses. So spread businesses have done fairly well for us. Another area that's done well are anything that are linked to commodities. So the stocks in energy, for example, stocks that are mining-based, steel companies. These stocks have performed quite strongly over the quarter, and we're trading at very low valuations coming into the quarter as well, so we've seen a big benefit from there. The areas that are not doing as well and have hurt performance, but fortunately for us, we're very underweight relative to our benchmarks, are areas such as the defensive areas, healthcare, consumer staples. These areas don't have a lot of, these companies don't have a lot of operating leverage, and as we're seeing a move towards businesses that have more operating leverage and with cheaper valuations, this is what's driving performance for us at this point. When we see people questioning a value rally after a long period of value underperformance, generally we get excited because it tells us, number one, people are not positioned for value to do better than growth. Number two, what we're seeing really from a real basis, and not just market hearsay, is better economic growth prospects. So we're seeing economic growth in Europe continuing to be a little bit stronger than most people are expecting. The Trump rally that we've seen in the markets is indicating that, well, we could see some better economic prospects here in the U.S. going forward with some fiscal stimulus coming into the country here. And along with the weaker currencies in the overseas markets, it gives a stronger indication that exporting from these countries will help these countries' economies. So there should be an underpinning to unemployment in these countries. It should be an underpinning towards better economic growth generally in their economies, and it gives us comfort to know that companies that are focused in these areas, their valuations are much lower than some of the growth and quote-unquote bond proxies that we've seen, the yield plays, and so it gives us an indication that with this valuation underpinning, we should see the markets continue to see fund flows back into these companies that on a relative basis should see their earnings growth begin to pick up. And that's a key for any value rally, is to begin to see companies have that strong relative earnings growth.